Good morning, everyone. Welcome to this breakout session. It's incredible to have 400 people in a breakout session. And we're very glad that so many wanted to join us for this session on a specific topic related to the Task Force on Climate-Related Financial Disclosures, how to use climate scenarios. So my name is Martin Skanka. I'm chair of the PRI. I've also been fortunate to be part of the TCFD group, and I have with me a very distinguished panel. Next to me is Curtis Ravenel, Global Head of Sustainable Business Finance Bloomberg, but also, of course, a driving force behind the task force. Commissioner Dave Jones from the California Department of Insurance. Mark Lewis, Head of Research at Carbon Tracker Initiative, also a task force member. You still have your banking suit from your previous job. Tricia Jamison from the 2 Degrees Investing Initiative, and then whereas Mark Fulton is not on the list, but he will give a presentation on a specific piece of work that the PRI is undertaking. Come back to that a little bit later. I want to just spend a couple of minutes on providing a little context. This is the short version of the task force recommendations. As many of you will know, it consists of 4 parts. It's governance, strategy, risk management, and metrics and targets. So the topic today is really one of these questions of this framework, which is the last question in the strategy part, where it says, describe the resilience of the organization's strategy, taking into consideration different climate-related scenarios, including a 2-degree or lower scenario. So this is a question in this framework, and I think it's fair to say that this is maybe the most radical or innovative part of the framework, and certainly one that we've found in discussions with our signatories, the one that people find challenging. What this really says, and it ties into some of the discussions we had in the panel on climate change yesterday, was, we want the companies we invest in as investors to tell us how they are going to make money if we're successful in climate policies. That's the short version of it. So it's about the resilience of business models in the face of this climate issue. And this is really crucial for investors, because investors are the ones who determine which companies get financing and which do not get financing. And so for a smooth transition to occur, investors need to make the right choices about which companies should be financed and which companies should not be financed. Are you happy with a particular company reinvesting what they make in their own company? Or do you want, as an investor, to extract that money in the form of dividends so you can reinvest in something which is more future-proof? And if investors make the right choices, they will help bring about a speedy and lower-cost transition to a low-carbon economy. So that's the whole thinking behind it, and I think it fits very well with the role of the investors in a broader context, which is to make these choices about financing, but these choices about financing in turn determine how well we transition into a low-carbon economy. So that was just by way of introduction and maybe setting a little context for why this particular question is so crucial for investors. But it also means that, number one, it's a challenge for companies to provide this type of information in a useful format, but obviously also a big challenge for investors to interpret this and use it. So that's sort of the dual challenge we're faced with. It's not just about increasing the supply of relevant climate-related information, but also increasing the demand for it and increasing our own understanding of how to use this and how you as investors can take this back into your investment processes. So these are some of the issues we thought we'd discuss today. I think well, let me just put that up as a reminder that the PRI has, of course, supported investors, and we've published lots of guides, so please visit our website. You'll find lots of material there on various aspects of climate issues, including guides for how to implement the TCFD recommendations. So I think I'll just stop there in the interest of time. So what we'll do is I'll invite the panel to comment on various aspects of this, and then we will have time for Q&A, so please just write down the questions you have and be prepared to ask them later, but we'll have some comments from the panel first. So I thought I'd start with you, Curtis. So the TCFD delivered its report a little over a year ago.
Yeah.
I understand that we're publishing a status update in a couple of weeks. So can you give us a little sneak preview
Sure.
of what that will contain?
Sure. Governor Carney and the FSB asked us for a status report to be delivered September 26 on this current status of how companies' disclosure may or may not align with the TCFD. I want to be clear that we're not trying to evaluate adoption based on TCFD, rather, because as Martin sort of alluded to, and I think it's an important point to make, many of the recommendations are not new, right? We borrowed quite heavily from existing frameworks, and I think it's a very we tried to rationalize for the investor some of the great work that's been done by others. The difference, of course, is scenario analysis is the newer thing, and I agree it's a fundamental differentiator, I think, of what the task force achieved. So again, we're going to release a report where we used AI to basically comb the universe of disclosure amongst about 2,200 firms in some of the sectors that we deemed relevant to this. So if you recall, we had four groups in financials and 4 in non-financials. And we also did some deep diving on some of the top firms that do it. We are not evaluating the quality of that disclosure. That's simply too hard. We think it's a little too early. So it will provide a good snapshot for sort of how disclosure today is aligned or not with the TCFD. That's number one. Number two, Governor Carney has asked us for a second report in June of 2019. In that report, we will look at 3 years of history to see where climate disclosure has come, how far it's come. I think it is, as Martin said, it's only been about a year. From a reporting cycle point of view, it's an odd time. But I think there's some good, useful insights. The report will also have some case studies of disclosures that we thought were good. We asked a number of analysts from both the buy side and the sell side to provide a qualitative and quantitative review of existing disclosures and what they liked and didn't like. And then there's also a perspective of user as a preparer group from oil and gas, because the World Business Council on Sustainable Development had just a small oil and gas working group, and so we get some context from them. So it's really intended to sort of say, where are we, what's going on? And I think the reason this session is so important is that scenario analysis is the harder part. It is new. How you do it, it's not just how you use it, it's how you do it. And we, as a task force, we were talking about this earlier, we recommended that you do a number of scenarios, including a 2 degree or lower. But there was a and you have to remember, these are 32 people from all around the world, different disciplines. To get us to agree on that was hard fought. But in the end, it was really...
But we're still friends.
Yes, still friends, barely. It really, I think we all agree that these recommendations are a 1.0 version of where we need to go. And so the work that PRI, the work that 2 Degree, the work that Energy Transition Advisors, Carbon Tracker, a bunch of other organizations, and I apologize I left you out because frankly, the count is large, and that's good. We have to go a bit further than we went, I think, in the recommendations to make it practical and usable to both the preparer and the users. So I think I'll stop there.
Great. But that means that in a couple of weeks, there will be a status
Yes.
report from the TCFD. It will contain case studies and good examples that hopefully are inspirational.
Yes. And I have to make my plug, as I always do. We set a target of getting 500 supporters by that time. And that includes groups like Dave's group, California Insurance, as well as both regulatory and non-regulatory support. We're trying to make sure that we have broad support from all industries and all regions. And we're up at 434, so if you have not signed on to be a supporter, we're coming for you.
Okay. So, Commissioner Dave Jones, you look at this maybe more from a regulatory point of view. So I just wanted to ask you perhaps to comment on how climate scenario analysis is relevant to you in your role.
Thank you. And it's a great privilege to spend some time with you this morning. For those not from the United States, I think it's important to start with a baseline. In the United States, insurance regulation is done at the state level. I lead an independent prudential regulatory authority, the California Department of Insurance. I regulate the largest insurance market in the United States, where insurers collect $300 billion a year in premium from California businesses, have about $5.5 trillion in assets under management. So when I first was sworn in 2011, I set about, with some other state insurance regulators, surveying insurance companies with regard to how they're addressing climate risk and climate change in their business operations, their underwriting, and their reserving. In 2016, I reached the conclusion, based on the work of Carbon Tracker and others, that on the investment side, insurers' investments in thermal coal in particular faced a high likelihood that that asset would be a stranded asset. And I also concluded that insurers were really not focusing on transition risk with regard to their investment portfolios. So I asked the insurance companies that I regulate, 1,300, to divest from thermal coal, and I required them to begin disclosing to me and disclosing publicly their investments in oil, gas, and coal and utilities that derive more than 50% of their electricity generation from fossil fuels. Been a big supporter of the TCFD, going back to when I was asked to testify before the Financial Stability Board in late 2015 about the work that I was doing in the insurance space. I fully support the recommendations of the TCFD. I'm not alone as an insurance regulator in this regard. I formed an international consortium of insurance regulators called the Sustainable Insurance Forum that includes the UK, Netherlands, France, Australia, South Africa, and that group collectively has supported these recommendations as well. One of the important recommendations, of course, is scenario analysis, scenario testing. And so in 2018, I became the first financial regulator to actually perform scenario analysis on the portfolios of the 600 largest insurance companies in the United States, those that collect more than $100 million in premium annually. We engaged with 2 Degree Investing Initiative, who you're going to hear from in a moment, and we actually performed that analysis on the portfolios of these 600 companies and then made it available to the CEOs and boards of these companies. I believe that it's a very important tool to use to assess what transition risk is faced by insurance companies in their investment portfolios. I would encourage you as investors and investment managers to embrace this tool as well. And I think it's very, very helpful because it provides me insight as an insurance regulator into what risks the companies are facing, and it provides insight for the companies as well. Next week, I'll be traveling to Mexico City for a supervisory college. Insurance regulators get together when insurance companies cross international boundaries, and I plan to take scenario analysis into that supervisory college, and I think we're going to see more uptake by insurance regulators internationally of this analysis as well, and our hope is that insurance companies will take up this analysis too.
Great. Well, thank you. So that, I think, leads us nicely into Tricia from the Two Degrees Investing Initiative and the PACTA tool. And I think I have a slide, if I'm lucky. The next slide will actually be on this. And I thought I'd ask you to comment a little bit about this tool and its usefulness.
Thanks, Martin. Yeah, actually, that is not the slide.
This is my slide, actually. But I think I have some more. I have more slides for you.
Perfect.
There you go.
So I have more than one.
Yeah, here you
Yeah,
go.
that's fine.
All right. All right, well, thank you. It's great to be here as well. I work for the 2-Degree Investing Initiative, if you don't know us. We're a think tank founded in 2012 focused on aligning financial flows with climate policy targets. I'm going to talk quickly about this climate scenario analysis tool that we've been developing over the past 2 years in collaboration with our partners, including the PRI, which is now online and live on the internet and free to use. I'm going to build suspense by not revealing the URL until the end, but it's just 5 slides, so you can take it. Oh. Okay, excellent. So why did we create this tool? Well, the objective was to help investors understand transition risk along 3 different dimensions. 1, what is their current exposure to transition risk? 2, how does that exposure relate to that of peers in the market? And 3, what is their future exposure? So this is a forward-looking tool. So underlying this scenario analysis is very granular asset-level data on companies' production plans. So this is at the level of the individual oil field or the individual power plant that we purchase from commercial business intelligence data providers. So we do not have to wait for companies to disclose about their ownership or use of these assets. We actually pay these data providers to do the sort of legal industrial espionage for us. And then the key value add of this tool is really mapping all those physical assets and production plans to the universe of financial securities in 2 asset classes, corporate bonds and public listed equity. So quickly, how do you use this tool? When you go to the URL, you'll first see a lot of disclaimer text. This is a diagnostic tool. This is not financial advice. It will explain a bit about the security protocols in place for the data that you upload. We ask for a bit of information so we can get feedback on the tool. But then an investor can use the Excel template that we've provided and upload their portfolio. It's fairly simple. We just require ISIN, market value, and currency. Once the portfolio is uploaded, there are 2 options. You can download a full PDF report with a set of graphs and explanation of those graphs, or you can choose to explore the data. Exploring the data looks like the screen to your right. And it really allows an investor to both reproduce all the graphs that are in the PDF, but also drill down to get a more granular view of their exposure to transition risk by changing some parameters. I'm not going to go through all the options, but I'm just going to highlight 2 points. First, the tool allows an investor to select which scenario they would like to assess their transition risk relative to. Kind of echoing what Curtis mentioned, it's hard to get everyone to agree on what the shape of this low carbon energy transition will look like. So when we think about the 2-degree scenario analysis, we often think of the IEA's SDS scenario, but the tool allows you to assess transition risk relative to other IEA scenarios, as well as scenarios from a couple of other providers. Secondly, the tool allows an investor to approach transition risk from either an alignment perspective, the notion of how aligned are my investments with this particular scenario? Is my portfolio doing its part? Or secondly, from a risk perspective, how exposed, or in terms of market value, is my portfolio to technologies that are likely to be impacted by the low carbon economic transition? Now, there's more on all of those options in the FAQ, which in the interest of time, I will encourage you to read on the website. Let's just quickly talk about some of the outputs. One way we think about the exposure to transition risk is by a relative share of production of green versus brown technologies within a sector. There are 2 graphs at the top here, which we see we're looking at the power sector. Each column is total power sector capacity broken down by the type of fuel used to generate that electricity, with the lightest colors being sort of the more greener fuels. On the left is the current exposure graph. So this would be 2018 data. The 3 columns show a breakdown for the portfolio that was uploaded by the investor for a peer portfolio in the market. The graph on the right is future exposure. So that would be 2023 data. Same first 3 columns, but you also see a target column, which shows the same kind of technology breakdown, but this time it's the technology breakdown that would be consistent, sorry, hopefully you can still hear me, with whatever scenario the investor is targeting. So the investor can compare the portfolio's planned technology breakdown in that sector with what would be consistent with the scenario. The bottom graph, for example, shows current exposure from a risk perspective this time. What % of market value is exposed to particular technologies? Again, they can look at the share of brown versus green technologies and also compare it to a market portfolio. Oh. Making a late appearance, the bottom graph, all right? So that was current and future exposure, sort of the starting and ending points. For an investor who wants to understand what's happening to transition risk in between, this is a 5-year trend, or what we call a trajectory graph. It allows an investor to visually compare a portfolio's planned production profile in a given technology relative to the other to trajectories that would be consistent with different scenarios. The solid red line here is the portfolio's planned production profile, or in this case, the amount of gas-fired power capacity allocated to the portfolio each year, while the dotted black lines that sort of separate the background are these alternative production profiles that would be consistent with each of the scenarios. See at the bottom you have B2DS, or a 1.75 degree scenario, at the top CPS, or a 6 degree scenario. So you can very visually see where the planned production profile, and again, this is data that we have purchased from the asset databases. We are not doing these projections ourselves, but where that planned production profile falls relative to each scenario. With the larger the deviation of the portfolio from the 2 degree scenario line would be a larger indication of transition risk. And the final output I'll show you is if an investor uploads their portfolio and they see some of the exposure results that I just took you through, it's obviously important for them to understand what is driving these results. The graph on the left, what that does is allow them to drill down to company level. The bottom portion of the chart on the left shows technology breakdown by generation capacity for power companies in the portfolio. So this is very similar to what we saw for the portfolio as a whole before, just at the company level. You can again see the green versus brown share of generation capacity. Companies here are ordered by impact, with the one at the top having the most production capacity allocated to the portfolio. The top part of that chart puts each of these company results in the context of a few benchmarks. A market portfolio aligned with the given scenario that the investor has selected, the portfolio's own 2 degree technology breakdown target, and then the portfolio's current plans. On the right, finally, is one of the graph outputs that we have, and it allows an investor to see where the production allocated to the portfolio is situated geographically. And this is important as different scenarios often specify quite different technology deployment paths for different regions, which can lead to quite varying levels of exposure to transition risks in different regions. All right, so I'll stop there. I hope I've given you a very quick sense of how to use this tool and the kind of value it can provide for free. As an initial starting point for scenario analysis, certainly in light of the TCFD recommendations. You have the URL, I hope you check it out, and we appreciate your feedback.
Thank you very much, and I'm sure you'll get some questions afterwards, but we'll move on now and give the floor to Mark Lewis. So you have, from Carbon Tracker, this 2 degree separation report, and I was thinking of that in the sort of, well, number one, its findings, but also as a basis for active ownership and engagement. Sort of how could investors use those types of scenario analysis that you have in their active engagement, active ownership efforts?
Absolutely. Well, thanks, Martin, and thanks for the invitation to speak this morning. I would say, having spent 25 years as a financial analyst covering most of that time the energy space and in particular the utility space, that the best place to start, I mean, there's 3 points I really want to make in the time available in terms of how you use scenario analysis. And the first one is, take it seriously. This is not a hypothetical, all right? This has already happened. It's played out already in the German utility and the European utility landscape. I'll talk about that in a second. The second thing, I think, the tricky thing about scenario analysis as opposed to sensitivity analysis, where, you know, analysts, financial analysts and investors all the time do sensitivity analyses where you're controlling for one variable. The thing about scenario analysis is you're controlling for a number of variables, and more importantly, you're controlling for the interaction between those variables. It's the dynamic interaction. That is a really crucial point, I think. I'll talk more about that. And thirdly, it can happen to any sector. If it can happen to the utility sector, which is, you know, by its very nature, a quasi-oligopolistic sector, if it can happen there, it can happen anywhere. So don't believe oil and gas executives or executives in any sector who tell you that what happened to the European utility industry over the last 10 years can't happen to us. If it can happen there, it can happen there anywhere. So let's just go through those 3 points in a bit more detail. The first is, it's not a hypothetical. I mean, I think the first thing to say is, the risk is that scenario analysis just becomes another box-ticking exercise, right? You say, oh, this is great, you know, we've got this tool, and isn't it great? And you get taken up with the intellectual fascination of it, which, you know, we're all analysts, we all interpret data, we love doing that. That's why we're in the industry we are. But it has a real-world impact. And none of us can say, I think the crucial point to say is, none of us can say how things are going to develop in the future, but the one thing you can say with absolute certainty is that they're not going to stay the same, right? So you really have to think about this seriously, and you have to assume that things are going to be different, and you have to game out a lot of different scenarios, because we're living in an ever more complicated world where it is just extremely difficult to know how things are going to. Disruption is the theme of our time, and I think that's the first thing. You have to approach this as if it's something that really matters, because it really does. The second point, about the interaction of variables, right? I always think about the energy transition risk as being a dynamic feedback loop between 3 or 4 key variables. The first one is public policy. You know, what are policymakers doing to change the landscape? Secondly, how does the public policy translate into private sector investor, whether it be industrial or financial, investor reaction? There's a technology impact. This is really important. And they feed back on one another. I mean, if you look at the experience of the European utility industry over the last 12 years, you had very ambitious targets starting to be put in place in 2005, 2006 for renewable energy, for energy efficiency. And in addition to being a financial analyst, mainly working on the sell side for most of my career, I spent 1 year working in a large German utility as deputy head of investor relations. And so I saw from the inside how they were thinking about the energy transition in 2005. And the answer is they weren't really thinking about the energy transition, because they were a powerful incumbent player who had been making very solid returns for decades. And there was a real sense that there's almost nothing that can go wrong with this business model. And what they missed, I think with the benefit of hindsight, we talk about scenario analysis, this is hindsight analysis, okay, but the past informs the future. And what they got wrong was they really missed the interaction of these variables. That's really what I think was lost. So the German government and the European Commission put in place ambitious targets for renewable energy, which were dismissed. I saw this from the inside, and I saw it as an analyst. I'm not claiming I got it right. You know, I mean, nobody did. If you go back 10, 12 years ago, you won't find any reports predicting that we would be where we are today 10 years ago. So it's very difficult for people to extrapolate the future. You always assume that it will continue more or less as it is. But the key point they missed is this interaction. You had ambitious policy targets put in place. I heard a lot of dismissiveness at the time about, you know, these targets are too ambitious, the subsidies are too high, there's going to be a political backlash, we don't even know if the electricity grid can take the level of renewables that the government is aspiring to over the next 10 years. And of course, what happened was, for the first 2 or 3 years, the targets themselves led to a lot of, and the subsidies were high, but the targets led to a lot of investment. The investment, crucially, spurred economies of scale. So costs started to fall much more quickly than the incumbents thought was possible. And when the costs started to fall, it became easier for the politicians to set more demanding targets. And that's what I mean when I talk about a feedback loop. So you have a public policy, you have a technology response, and then you have a public policy response to the technology response. And that's what's played out really over the last 10 years. And the cost reductions have been so much greater than anybody thought possible 10, 12 years ago. There's now a third element in this feedback loop, and it's you in this room. There is investor preference, which is starting to come into the equation as well, and is informing that feedback loop. So investors look at what's been happening over the last 10 years, and they say, well, we ought to be more concerned about. This is exactly why the TCFD was set up in the first place, right? If you think back to why Mark Carney set this up in the first place, he often talks about the German utilities as being the poster child of transition risk. That's how it can happen. So investors now are part of this equation, and the way that you put pressure on companies is informing that whole feedback loop. So I think that's a very interesting thing. But that's the crucial point. It's a dynamic process, and finally, it really can happen anywhere. So I often find when I do this talk about scenario analysis and what happened with the German utilities, if I find myself on a panel with oil and gas executives, which does happen from time to time, they say, oh, it's completely different, totally different. It's what happened in the power sector in Europe is a result of electrons being competitive with one another. A solar PV generated electron can compete directly with a coal-fired generated electron. But electrons can't compete with molecules. You know, we're in the business of liquid transportation fuel, and therefore your analogy breaks down. Well, guess what? In the last 2 or 3 years, we've had this huge increase in investment in electric vehicles. We've got the same dynamic playing out, this feedback loop. Public policy response. China, India, really pushing for electrification for many reasons. That will play out, without a doubt, in a technology response, which will lead to probably a much quicker reduction in the cost of electric vehicles than even the most forward-thinking analysts are assuming today, because that's the takeaway from the last 3 years. And so, to conclude, those are the 3 things I think that you need to take into account. Take it seriously. Think about the interplay of the variables. Don't control for one variable, control for a number of variables, and think about how they interact with one another, and assume that it can happen anywhere, because if it can happen in the utility sector, it can happen to any sector. And Martin kindly referenced our piece, 2 degrees of separation, which was written with the PRI. That is exactly what I'm talking about. It's an attempt to look at scenario analysis with regard to the oil and gas sector, drawing on some of the lessons I've just been talking about now. So please go to, if you're not familiar with that study, please go to our website, carbontracker.org, and look at that and think about the way these 3 factors interplay with one another.
Thank you. And I think we can cover in the Q&A, I'd be interested to come back to this issue of engagement and how you could sort of use these kinds of reports as the basis for constructive engagement. So let's put that on hold for a second. And Mark Fulton, or just to provide a little context, so you may remember yesterday after Al Gore had his speech, Fiona Reynolds presented some thoughts on climate work from the PRI, including the work on what we have labeled the inevitable policy response. And so this is one possible scenario that we think investors should be aware of, and it's a scenario where we have policy delayed but very forceful policy action. And Mark is going to take us through some of the issues that will be raised in that work.
Thank you very much, Martin. And so you're going to say this is a scenario meeting. What is the word inevitable doing here? Well, there's only 2 things that are inevitable. We know death and taxes. But what I'd like to do is pivot here a bit and pick up what my colleague Mark Lewis was saying. Is I think it's time to shift. The word scenario worries me a little bit. Is that a good excuse to say, oh yeah, it's a scenario, who cares, you know, done that. So I worked in the investment banking industry for many years, actually with Mark at Deutsche Bank. I was a head of research at Citigroup. I've been a strategist and economist for many years, and I don't remember ever presenting a scenario to anyone in this room. I presented a view, and you thought about that. You decided, okay, it's stupid or it isn't. But if I didn't present you a view, I don't know if I shifted the room at all. So PRI have sort of thought about that, and they said, okay, why don't you go off and look at what you think we think also might happen. It's got some strong probabilities, maybe, and we can still talk about scenarios, and we will, keep you happy, but I'm going to pitch this, all right? This is sell side here. You know, have a think about this and watch out. So, oh God, have I gone the right way? Hang on. There we go. So again, what we're saying is essentially without stronger action now, we don't get there. So we think we're in overshoot. What are we going to do about overshoot? We think they're going to respond to it. Now, the timing of that, the policymakers' response, is, of course, a so-called scenario. It's unknown. We're actually thinking that the 2023 stock take in the Paris Agreement will lead to a pledge change in 2025. And for astute political minds, you'll have noticed that is 1 year after the current administration could possibly survive, unless there's a coup. So, essentially, we think that these policymakers will be ready for action. And we actually do something that, if for policy watchers, you'll know this, you announce and you implement with a lag, you get the effect at the announcement, but you let the markets adjust. And we've allowed, in this idea, quite a long adjustment process, because there's a lot to do. So essentially, I came in, got a group of us together, including Vivid Economics. I don't know if many of you know them, but they're one of the important consultancies in the UK, to work on putting a framework together, which we then hope to develop into a work program over the next year. And we've developed this into what we call the why would it happen, the when, what, okay, and how, and then how will that would impact strategic asset allocation, and then also what that would make you guys want to think about doing. Oops. So, I think this affects all stakeholders. And it's not just aimed at investors, to be honest. This is companies, this is policymakers. Everyone's in this idea. Now, I'll go back to the point being made, and I'll make it again. The starting point that you'll have to close the gap from in 2025 will be NPS, the new policy scenario of the IEA at that point. And that will be influenced over the next few years by technology trends, changes to policy in the interim, and investor engagement with companies to change the system. That's why we call it Act Now. This is not sit back and think, oh yeah, okay, that means I'll wait till 2025. This is, okay, you can help force this transition, make the disruption less, and you need to believe it's coming. So again, for investors, engagement, governance, service providers, and the portfolio construction. So again, this is an intended work program. We need to spend the next year working on the details. So are we mad? Well, I must admit, I said to Nathan and Fiona when they put this vote up at the plenary yesterday and decided to vote on this idea, I was a bit taken aback of, oh my God, I hope we win this one. And we did. So 63% of you thought that a disruptive policy response was the most likely. Hang on, likely. It's not a scenario, likely. So, here we are. We're going to model a disruptive policy response for you. If you add in technology, which really is we're saying that's part of this. You'll never get there without the technology working with you. Then we're up to, 75%. The 5% that believe we're going to make it now, I wish them well. And for the 16% that the world's going to end, remember, move to higher ground. So, are we right that we're in overshoot? I think I don't have to establish that. We're in overshoot. We're at between 2.6 and 3 something. There's no one that thinks we're not in overshoot, right? We don't know, so we're not going to get there as we sit there at the moment. So something's got to happen. And as I go back to it, what can change it is technology, speed of adoption. And I want to recognize my colleagues at Carbon Tracker. They put out a really interesting paper on peak oil demand and the trends in the underlying technologies that came out a couple of days ago. These are very important trends, right? Very important. Policy itself, we're not giving up on the fact that we've got more COPs. We've got the UNSG meeting. People are going to try a lot, but it's not going to be easy. Hence, we've given them a fair bit of headroom out to 2025. A lot of people say that's way too early. They'll never get there by then. But I tell you, if they don't get there by then it gets into much more difficult. And then investor actions. You guys can really help align this system early now and make sure that disruption is way less when it comes. So, I'm a Brit originally, so you've got to read The Sun, you've got to read the tabloids, I was blown away when I saw the IPCC map on the front page of The Sun. So, okay, of course, we've got the hurricanes coming in now, so I haven't got a hurricane for you, but that was what it looked like when we put this together over the summer. And, you know, Al Gore, you know, he told you what was going to happen. He actually set this up, I thought, rather well, you know, disruption, we need policy, we need technology, same story. So why would it happen? Essentially, one of the things as an economist I'm really keen on is certainty in markets. That's what makes markets more efficient. Companies want certainty. You want certainty. That's what Exxon said. They come give us a carbon price, right? So essentially, we need certainty. And policymakers cannot let the sword of Damocles hang over the world economy forever. It's not good. Falling costs of low-carbon technology, going back to this point, the reason why this can happen is it's getting less expensive to do it. Totally crucial. And as it gets less and less expensive, the policymakers can pull the lever with more confidence and avoid the massive cost of damages in the longer run. Climate science will continue to show us how bad this can get. Civil society unease, going to be very important on the politicians. Security, migration, food, water, just a few mild things, right? The 100 million people that might be on the move if this stuff goes wrong. So that, I think, I mean, as you know, the Pentagon have got papers on it. When I was at Deutsche Bank, we used to go and talk to the US defense guys because they were modeling this stuff. So again, finally, the Paris Agreement itself, I think, has this built in with the ratchet mechanisms. They were ready for this. That's how they see it working. So there's the ratchet mechanism. The 2023 stock take, I'm not going to spend long on this, is actually a very important moment where they actually decide who the hell is doing what and how bad it is. By the way, at the moment, 2020, I live in hope, but, you know, that may be, this kind of administration has a lot of control over that one. So essentially, 2023, 2025, let's announce it, and 2030, let's really hit everyone with it. And what would you be hitting them with? Okay, so again, this is not going to be news to you. Carbon prices in all their different forms, cap and trades, taxes, I happen to be a tax guy, all economists know tax is most efficient. These ways, this is going to be the core, one of the key cores of the response. And everybody knows it's got to come, right? Demand-side policies, performance standards, we know we're going to need those. We're going to need efficiency standards, supply-side responses. We are going to need some, you've got rid of fossil fuel subsidies. We're going to need some constraint on the supply side. And the one at the bottom is really controversial. We need to explore what CCS and negative emissions technologies really mean. In our papers, which you'll find on the website, you'll see there's a big discussion of the issues around CCS and negative emissions technologies, and that's going to have to be explored in this work. Now, going back to my colleague, Mark Lewis, you know, carbon pricing. That's what we're exploring here. It's starting again. It's going to get going. Now, I'm going to say to this, I'm going to make a slightly controversial statement and say to you, I need 3 blocks. Who? I need the US, I need the EU, and I need China, and then I need border tax adjustments. And then the rest of the world, bang, done. So it's not going to be 198 countries negotiating this, in my view. The big guys will just say, we agree, we're on, we need certainty, this thing's out of control, bang, you're in or you're taxed. So, how? This is where vivid economics come in. I'm not going to spend a lot of time on this, but it's going to be modeled. We're going to we propose to model the whole system if someone funds us. Nope, slight pitch there. But essentially, it will be a full-blown model. We will start with the IEA, but it will be exploring all the different aspects of what you might put into such a model. At the end of the day, it will give you what in the room you want. It will spit out from the asset level up to the portfolio construction, the data that would come out of that. That's the goal of this, to actually make this actionable by investors, by value streams. There's a big task, but they think they can do it. So this would then, on strategic asset allocation, I'll make just some simple points here. It's got to be forward-looking. Now, the next time you put your 5-year moving average of risk, return, and correlations into your optimizer, just think about it, right? That doesn't quite work for a disruptive outlook in the future, so it's got to go forward-looking. We actually want to explore some new different mean variance approaches. The lady that put this together, Daniel Guyot, ran Mercer 1. She's well aware of the issues around, you know, the slow moving, takes 30 years, and by the time the paint's dried, you've all gone to sleep. Portfolio effect. You shock the system, you'll find something more interesting going on. And again, one of the issues we're going to look at near to my heart is, you know, what bucket does this all go in? What's the structure of your asset allocation? Do we need low carbon beta buckets? How are we going to structure this at an asset allocation level? Because actually people are really struggling to get the green side of this in. Let's be honest about this. And that's a very important part of the study. So investor actions, my colleague and partner Julian Poulter used to run AODP, working with me now, and essentially he's got a whole list of things that he thinks you need to do, and he's not holding back on that as usual. And essentially, you know, we think you need to prepare for this. You need to make sure your governance is fit. You're working with your service providers, and the list sort of does go on. When you get to that document, have a read. It's a long list of what we think you might want to think about. But essentially, you know, you've got to work with your asset consultants. They've got to come up to speed on this stuff. You've got to work with all the different, you know, the ratings agencies. You've got to collaborate among yourselves, we believe. So if, in other words, we shift from just another scenario, but we can shift people to think, you know what, something might really happen, let's get going. And I'm going to say it, the mainstream investors, maybe the 90% of investors that think this is all gobbledygook, maybe, they say, hang on, that might be economically true. We maybe really have to look at this. The CIO and the investment teams really have to look at it because it's a proposition that's been put to them that might actually play out. So 5 papers on the website, 150 pages of scoping with frameworks, ideas. I know you'll all read it, but do enjoy. Thanks.
Thank you very much. So, as I said, this is a work stream that we're launching now, and please do read this material and provide input. This is not something where the PRI can sit in his office in London and give you sort of advice. It's supposed to be a collaborative effort engaging our signatories. But we think this is a worthwhile initiative and that the process itself can give us some insights. And I think in a lot of this work, it's not just the end result it's the process and what you learn through the process. And so this is a really good opportunity for all of you to get engaged in this work and hopefully learn things that you can take back into your own organizations. I've already seen a couple of hands, so I think we'll start there, and some nice people with microphones, and we'll have the second one there afterwards. But yes, please, and please identify yourselves before you.
Thanks, Martin. It's James Leeton from Moody's. I was interested how the panel are thinking about timelines, because there seems to be a range there from PACTA that's only looking out 5 years against 20 plus years IEA scenarios versus the inevitable policy and the peak fossil fuel being post that period. So what are the options and thinking there?
Who wants to tackle that? Just one reflection is that obviously from a valuation perspective, discounting means that the first 5 years are pretty crucial.
Yeah, no, I think that's absolutely right, Martin. I think it's exactly the point I was making earlier about how you think about this. You can't just assume that this is we want a timeline, 5 years, 10 years, 15 years, as if it's something that is predictable. The whole point about a scenario analysis is it's not predictable, and you're trying to control it. And you're absolutely right. The other key point for investors is that the future doesn't have to play out for it to be, fully, for it to be reflected in current share prices or bond prices. Markets react in real time to their assumptions about the future. And if those assumptions change, the valuation changes very, very rapidly. So I think you have to think about, the timeline for change in a given industry, but you also have to think about how the market will react to the changing perception of that timeline. So it's two separate things. One is the timeline for the reality, another is how quickly the market prices in, and it happens, the basic conclusion is it happens more quickly than we always assume.
So again, I think going back to the notion of a shock, that is inserting a potential time point into it to get everyone to concentrate on specific actual things that would then happen and valuation effects. So I understand that, of course, I think what's inevitable is they'll act. What we don't know is how big it will be, what and when. That's fair enough, which is what Mark's alluding to. But in our world, something will happen. And we think there's a credible argument to try to argue for this 2025 sort of time frame. A thing you've got to be aware of is the longer the time frames go and you overshoot, it's just a different world anyway. It's like, if we're starting to if we're overshooting in 2035, I mean, who knows what the world looks like. So we've tried to sort of bound it into a time frame of at least possibility to act and get results and see implications. And as I say, therefore, again, it's more of a let's challenge you on a specific event at a specific time.
I guess the only thing I would add is I don't want folks to leave here thinking they can wait till 2025.
Well, that's another
And as a financial regulator,
Right.
I don't want the insurance industry leaving here thinking they can wait till 2025.
Right.
I want them to take up the recommendations of the TCFD, including scenario analysis, and begin evaluating their portfolio's exposure to transition risk now, because as Mark pointed out, due to this feedback mechanism, things can move very, very quickly in unexpected ways. And so my view is don't wait, act now, and begin to use these tools, which 2 Degrees and PRI have now made available, so you can begin the process of evaluating what your risk is.
Hi, Linda Giuliano from Alliance Bernstein. A quick comment and then a question. So thanks to each of the panelists. I think you all provided really valuable insight. I think what would also be helpful in the future is if we could have a corporate at the table. As this discussion is going to continue, I think it's important for us to get perspective sort of on the inside. And so my question is related to that. It's for you, Curtis, and yes, we are a supporter of the TCFD.
Thank you.
So the question early on, you talked about this being really version 1.0 and that more needed to be done to make this more practical and usable. And I'm just wondering if you could provide a little bit of insight in terms of where you're seeing or what your thinking is on what really needs to be addressed.
Yeah.
So the dialogue with corporates,
Yeah.
that has been crucial. So
Yeah, no, and it's a fair point. I mean, the title of the session is how to use scenario analysis. It is at investors, but I think it's a totally fair point. The corporates, what I've been telling, I'm actually, somewhat, on the one hand, on the other hand, I'm somewhat optimistic about the interest the corporates have, but they're scared. They are, I think, falsely conflating this with providing forward guidance. It's not forward guidance. It's scenario analysis, which is done by many corporates in many sectors all the time, just not generally on climate. I also think that this makes a point about the corporates too, which is that if you don't own the narrative, it will be owned for you by someone else. Right? There is enough information, asset level data, big data, all the AI and natural language processing stuff that's going on, where investors do have enough information to make assumptions and to form a view. And so I would encourage corporates to get in front of it. Now, with regards to corporates, there are working groups in almost every sector now that we identified, the 8 sectors, which is asset owners, asset managers, insurance and banks on the financial side, and then energy, transportation, materials and buildings, food and ag on the non-financial side. And I'm pleasantly surprised to see a number of working groups set up in these different sectors around the world trying to figure out how they go about doing this. And so there is this demand-supply dynamic is very important. It's important that the investors in the room use these tools to engage the companies. And I think the companies actually are appreciative in some way that they have an ability to tell a story about their future that they haven't before. It is an opportunity for them. We talked about climate risk and opportunities. I got sick and tired of writing climate risk and opportunities, climate risk and opportunities. Because the opportunity side is very important, and we don't talk about that enough.
Just to add to that, I mean, there has been dialogue also bilaterally between a lot of investors and companies that they have relations to, that they have invested in. And I think what I would like to see is maybe building up a library of example disclosure reports. The TCFD framework is a great framework, but I think many investors also would like to see, and many corporates would like to see examples of good reports. And I think that's the stage we're at now, where we need to find those good examples of how people have actually reported according to the framework, to find formats, templates that people can use that reflect both investor needs and the corporate needs.
Right, and just last point is, TCFD is based on financial materiality, right? We're talking about how does climate potentially impact the financial performance of a firm, as opposed to how these firms may impact climate writ large. And that focus on materiality, of course, SASB, Sustainability Accounting Standards Board, and CDSB also focus on that. And they're coming out with a paper in a week or two that says, here's how you use our frameworks to report. And I think those kind of tools that we're developing on the investor side are being also developed on the corporate side for corporates to pursue this.
Okay, next question is in the back.
Hi, good morning, everyone. My name is Viola Lutz from ISS ESG. And what I would be really interested in, I mean, we've talked a lot about in this panel on the complexities of it. I think as Mark said, it's really scenario analysis is about looking into multiple futures, making sense of them, feedback loops. The complexity can be incredible, at least. So what I would really be interested in is kind of to make sense of all of that data and to make sure that this doesn't develop into a tick boxing exercise. I would be really interested into examples of how investors are already using these kind of tools for actual decision making, because I think that is the type of application they can motivate to get into the topic and understand the details, if it really then has this very practical results and can inform decisions on the ground on a large scale.
Great, thank you, great point. And that's obviously, I think, something that would be central for the PRI, to share those good practices from our signatories of what investors are doing and how they're actually using this. So this is, I think, a challenge for us in our investment practices work, that through the work that we do on identifying good practices and sharing good practices, that we're able to disseminate these practices through to our signatory base. But these are the kinds of case studies that I guess the TCFD report also would like to highlight.
Yes, and TCFD report does begin to do that. It was interesting because we had a lot of analysts helping us look at this, and it's somewhat new to some of them as well. So this is going to have to be a very big collaborative process amongst all the different players. I think Mark Fulton made a really good point about the rating agencies. You got to have stock exchange. Look, in the end, disclosure is just a means to an end, right? Where the market allocates capital efficiently given all available information. It hasn't had the information. Right. So disclosure is important for that, but in the end, it's about that actionable. Is this decision useful information that is then actionable? And that is where we need to go.
We have time for one or two more questions, and there's one there in the back, and then one there, and I think those will be the two last ones.
Great. Is this on? I'm Lauren Compare of Boston Common Asset Management. I wanted to raise the issue of beyond sort of TCFD and the climate scenario, the whole idea of the ecosystem. And the ecosystem also includes lobbying and public policy engagement. And so I don't know, TCFD does not explicitly address that in the recommendations. How do you see the whole idea of even positive climate lobbying influencing the climate scenario, so both negative and positive. Do you have a position on this? And I do want to call out the PRI did issue guidance for investors specifically on this, so PRI is taking on this issue.
I'll just quickly say, with regard to TCFD, you know, as you can imagine, it was hard to create the task force. You have countries like our own and others that were not exactly thrilled to do this. The reason they were able to get it launched was because it was private sector-led, voluntary initiative for the market, by the market. So officially, TCFD will never get into any policy making. It's part of our remit. So I'll stop there.
But as you say, the PRI has been involved, and I think you know, looking at the toolkit that's available to investors, engaging with policymakers is one of those tools, and it's a tool that many investors have used, and the PRI has organized these kind of investor statements ahead of the Paris Summit and at other occasions, and we will continue to do so. I think it's a part of what investors could usefully be engaged in. Last question.
Hi, Chris McNatt, Wells Fargo Asset Management. This is not a but, it's an and, because I'm a buyer. But it strikes me that the preponderance of the carbon underground is state-owned. And what are the transmission signals that can affect you know, the type of trajectories that we're talking about here? Is it sovereign creditors, civil society? How do we think about that?
You know, Mark, in the 2 degrees of separation report, there is, you know, a breakdown on different types of entities, including state-owned oil companies. So maybe you could say a few words on their crucial role in this.
Yeah, absolutely. I mean, clearly it's more difficult because the transmission mechanism via a market price is not there. I mean, companies that are partially state-owned can also be less rational than fully state-owned enterprises. So it's going to depend on the government in question a lot of the time. But a great example that's playing out right now is in Europe in the Polish energy sector, where Poland is, you know, very heavily focused on coal. 85% of their power generation is from coal, and some of the companies there are majority state-owned, but they do have a stock market listing, and via a combination of engagement using these tools, but the market signal as well. And to Mark's point earlier about carbon pricing, you know, we've had a resurgence of the carbon price in Europe over the last 12 months. If you plot the share prices of Polish power companies versus the European carbon price over the last 12 months, it's an exact mirror image. So I think what you have to do in the case of state companies, and clearly it depends how able you are to talk to them, and if you're not a shareholder, then it's very difficult to get in the door if they're not quoted. But the market signal is nonetheless there. And you just have to do your utmost via regulators. I mean, you know, people like Dave, very important, the signals that policymakers and regulators send to industry globally. And I think, you know, lots of speculation at the moment around Saudi Aramco and whether the IPO is going to happen or not. But clearly, very clearly in my view, even though until now they've not been a quoted company, they will be worrying about all the things we talked about in the 2 degrees of separation report. They will be doing scenario analysis, and if they do come to market, we'll have a much better opportunity to influence them. But the point is, I think as the largest oil company with the most reserves in the world, they will be running these scenarios as well. They have to be doing that. So I think as a tool, it's applicable, it's equally applicable. How you enforce it, how you engage with these companies will obviously depend on their openness. But at the end of the day, nobody can avoid market signals for over the long term. And that's the crucial point.
Martin, could I pick up there, going back to a couple of points here about, so the going back to act now, absolutely. And one of the big actions is indeed picking up. I mean, investors must talk to policymakers and governments. Right. You know, it's not just market. Let's face it, if the biggest problem in the whole carbon thing is the Chinese thermal coal fleet, that's pretty heavily regulated, right? That's owned by the government, in effect. So if you're not if you don't have a strategy for that, then this whole idea of we're going to solve the carbon problem doesn't make a lot of sense to me. Hence, our argument, it is market forces combined with government action that have to come together. Now, I think the point being made by Martin is that you guys can still make a big impact on those governments. So it might be inevitable they do something, but what and when isn't. And you guys, sort of not lobbying, bad word, you guys saying to them, we want you to act, we want the certainty, we think you should get on with it. And that can include the Chinese. Why not, right? So I think it's very, very important. That, to me, is the most important thing, is you engage with the companies now to say to them, this is going to happen, let's get on with it. And you go to the policymakers and say, we do expect it to happen.
And I think just to close off on this point, which is crucial, obviously, the longer we delay action, the harsher will the measures have to be, because the climate change effects comes from the accumulation of CO2. And so the longer we wait, the more we will have accumulated before we start doing something, and the more we have to do to get emissions rapidly down. And so from an economic point of view, obviously that sort of very late but forceful policy reaction could have very negative impacts on the values of your portfolios. It will be, in economic terms, a much costlier transition than if we have an early and smooth approach to the transition. So I think from an investor point of view, as also a useful way of framing it and thinking about it and justifying why, as investors, you should be pushing for early action rather than later. So we've spent our time and more. So I thank you all for joining us. I hope that you've had a useful session with us. And again, I'll just refer you to the PRI website, where we will be posting lots of material on how you as investors can think about these issues. So thank you for joining us.